Alright, so today I wanted to do a video on a stock that I don't believe I've done a video on before, being Google or Alphabet, depending on how you want to put it. Again, I don't think I need to get into what they do. They basically are at an all-time high right now. They just recently hit it, basically within the last month or so. And then they fell off recently due to earnings, and then they're slowly climbing back up. So again, looks like the high was about 153. That was back at the end of January, and again they came all the way down into about the high 130s after that. So again, that's quite the downturn for a company of this size. But again, if you look back at the last high point, it was in the high 140s. So again, it has broken basically an all-time high. It's very close to that again. It probably does go back. Again, my prediction for the markets have been, I think we're going to trend higher over the short term, medium to long term. We're going to see I mean, it depends on what your definition of long term is, but over the next year, let's say, medium term, we're going to see a correction. Long term, I still think we close the year up, although again, it might be 5,000 on the S&P. That might be where it stays, right? So I think it's probably a modest up year in the end. But I do think Google is a really good company. The one problem is they are too expensive in my opinion, which I will get into. So let's get right into it here. Again, if we look at the numbers here, just from a bird's eye view, again, analysts are fairly bullish. Financial health, they're solid. The one concern is stock-based compensation, I think. Profitability, they're very good. Growth, they're very good. Management, again, stock-based compensation is the big one. If you look at the valuation, again, they are below their 5-year averages, but I still think that it is a little bit expensive in my opinion, which I'll get into. So again, let's get into the financials here, because this is really the bread and butter of investing right here. Again, if we look at the income statement, shares outstanding, again, as you can see, this numbers actually went down slightly over the last decade or so. But again, given that stock-based compensation, that's the reason for it, which let's get into here and show you, right? So again, shares are basically steady, but if we look at the net change, the share issuance, it's actually going down pretty significantly every year. So again, if the actual diluted shares outstanding is only going down very slightly, but they are buying back a lot more shares, again, that means that they're issuing shares to insiders, which again is a commonality. A lot of companies do that it's not necessarily a red flag. The red flag comes into where it becomes excessive, which I think Google definitely would fall under that category, right? So again, if we look at debt, last 3 years they have paid down debt, which is good to see. They don't pay a dividend, so again, that's not something that you really get into. If we look at the free cash flow growth over time here, very, very impressive, right? Extremely impressive. And they are above the 2021, which again was the last high in the market, which is good to see if you're looking to buy a Google, right? So the other thing here, again, balance sheet. Let's look at the balance sheet again. They have a strong balance sheet. I would say it's good, not necessarily great, but again, I don't think they're going to have an issue as far as that stuff goes. Again, if we look at the margins here, just getting right into it here, again, they've been very consistent over time. I mean, going back 8 years, the lowest their free cash flow margin has been is 16%. Operating cash flow margin, the lowest it's been is 33%. So again, they're very, very consistent there, which is very good to see. If we look at free cash flow per share, again, this is something that, again, they've grown extremely well over time here. Again, this is one of the bread and butter ways of figuring out good businesses. If they can consistently grow this number, it's a very good sign. And again, the one other thing here, if we look at Google, again, like I said, balance sheet, very good, right? Liabilities to assets, again, I got into that. But again, let's look at the valuation here, because this is really the key here. Again, you can find good companies, but again, you got to keep an eye. What is the valuation, right? What is the valuation, right? So again, if we look at the historical valuations, again, over the last 5 years, over the last 10 years, the average price of free cash flow has been 42, and which again is expensive, right? The latest 39, that's certainly expensive. Let's go back 5 years or so just to see, just out of curiosity here. So again, the number does go down to 40, but again, I still think that's too high. Again, if we look at the lowest it's been over that time, 25, that's probably closer to what I would be paying for this company. In my opinion, it would have to be around that 25, 26 level to want to buy it, because I don't necessarily think this is a bad company by any means. It is a very good company. But the one thing you got to keep in mind with a lot of these companies, especially the ones that are very large, is the concept of diminishing returns, being it's impossible to grow at 10% a year forever or 20% a year forever, because eventually you would literally become the entire economy, right? Like they would be bigger than the entire US GDP, right? So there's going to be diminishing returns. And again, the bigger you get, the more likely it is that there's going to be diminishing returns. So again, you really got to keep an eye on the valuations you pay for companies, especially the very large ones. Because again, going from $1 billion to $100 billion valuation is easier than 100 to $1 trillion, right? Same percentage, but it's easier, right? Going from $1 trillion to 10 trillion, again, harder than 100 billion to $1 trillion, right? So again, this is the thing when it comes to these really large companies. You got to be really careful, because there's a lot of people out there that I see that just blindly buy these companies thinking that it's going to be some guaranteed return. Like, look, they've returned 100% over the last 5 years. I'm gonna double my money in the next 5 years, because they did it last time. Again, number one, previous returns doesn't equate to future returns, and number two, again, diminishing returns. Be very careful. So again, people would wonder, okay, what's a price target to buy it at? Let's go back and do that, just out of curiosity here, right? So again, if we go into the DCF here, we'll go 10 years to project. We'll do it based on free cash flow. So again, the 5-year average is 20% growth. Again, they're not going to do that in my opinion. Let's say we're going to pay a 25 price to free cash flow. They're definitely going to do more than that, I think. Let's say they're going to do that by 3%, or even 5% at this rate. And again, they're going to grow at 15% per year. So again, well, let's maybe be a little more reasonable here. So 4 or 5, what was the average? Let's say 3, because the average according to this is 1.62. But again, that's a little low from what I can tell. Again, so they're going to grow 15% per year. I mean, honestly, I think that might even be a little bit too aggressive. Let's go 13, right? So 13 to 15 is my opinion. So again, if they grow at 13, the fair value is that 136, right? Which is, I think, roughly what they corrected to recently. So again, that's my fair value, at least based on my projections, right? Again, let's say you want to be aggressive and give them a 30 price to free cash flow. Then the fair value is 163. So the question really depends: how fast do you think they're going to grow, and what's a fair price ratio? I think 25, maybe 26. Let's go with the average, right? Again, according to that, the fair value is 141, right? So that's something to keep an eye. Again, this is another good tool here to play around with when you're looking at buying companies, because it'll show you, okay, what's a fair value right now, and how fast are they going to need to grow in the future to justify buying them, right? Because if you look at a 25 ratio with 13% growth, they're going to dilute at 3% a year. That means they're going to grow 9% a year over the next 10 years. Which again, I think is good. Like that's pretty good. That's roughly what the market grows, maybe even slightly more, depending. So again, I in my opinion, again, fair value definitely is a little bit below where it is right now, but I don't think it's crazy expensive by any means. It's certainly not crazy by any sense of the imagination. Nvidia is, I think Tesla still is, Microsoft still is. But I mean, if you look at Amazon, I don't think they're crazy. If you look at Apple, I think they're maybe a little bit. Amazon and Apple, you'd want to get a little bit cheaper for sure. But again, if you look at a lot of these big companies, some of them certainly are. Like Nvidia, the best example of this, Microsoft, again, definitely overvalued. But again, aside from some exceptions, I don't think the market is as expensive is what some people are making it out to be. Again, just my opinion, but again, that's what I'm saying. So again, last thing here, if you liked the video, please like, subscribe, comment, all that good stuff, and stay tuned for more.